Okay, so you want to own a Starbucks. You walk in every morning, you hand over $6 for a latte, and somewhere in the back of your mind you think, whoever owns this place is printing money. The line never stops. The coffee costs less than $1 to make. It looks like the easiest business on earth. But here is the thing nobody tells you at the front of that line. You cannot actually buy a Starbucks. Not the way you buy a McDonald's or a Subway. In the United States, the company will not sell you one at any price. And that is your first clue that this was never really about coffee. The real money is not in the cup. It is not in the food. It is not even in the stores you can see from the street. The real money is sitting quietly on a balance sheet, and almost nobody who walks through that door ever bothers to look at it. So let's follow the money, not the brand, the balance sheet. And before we go deeper, one quick thing. This channel pulls apart the numbers behind the brands you use every single day, the ones hiding in plain sight. If that is what you want more of, subscribe right now, because the deeper we go into this one, the stranger it gets. By the end, you are going to see Starbucks as something much closer to a bank than a coffee shop. Let's start with the big picture, the way Starbucks itself describes the business to investors. When the company reports earnings, the revenue comes from three places. The largest is company-operated stores, the ones Starbucks owns and runs directly, generating more than 80% of total revenue. The second is licensed stores, the kiosks inside airports, grocery chains, and hotels, at roughly 12%. The third is packaged goods, the bags of beans and bottled frappuccinos in your local supermarket. 3 streams. 1 machine. But to understand how that machine works, you cannot start at the top. You start at the bottom, with a single cup in a single store. When you pay $6, you believe most of it is buying the coffee inside the cup. That is not what is happening. Not even close. Let's deal with the first mystery. Why can't you buy one? McDonald's will happily take your money. So will Subway, Dunkin', and almost every chain you can name. You bring the capital, you follow the playbook, you pay the fees, and you get to hang the logo over your own store. That is the franchise model, and it built most of American fast food. Starbucks looked at that model and said no. In the United States and its most important markets, the company refuses traditional franchising. The closest you can get is licensing, and even that is not open to just anyone. You do not get a license because you have money. You get one because you already control something Starbucks wants access to. A terminal at a major airport, a campus at a large university, the lobby of a big hotel chain. You need to already own the prime real estate before they will even talk to you. Why turn down thousands of eager buyers waving checks? The answer traces back to Howard Schultz, the man who built the modern company. Schultz was terrified of one thing above all else, and that was losing control of the experience. A franchisee is an independent owner. They cut corners to protect their own margin. They let standards drift. And once one cup in one town tastes wrong, the whole promise cracks. So they do not want your money to open a store. They want total control over what happens inside it. This is not a flaw in the model. It is the entire point of it. Now let's do the thing nobody at the counter ever does. Let's take that $6 latte apart, cent by cent. And one quick note before we start. These are industry estimates, not Starbucks' exact internal figures. But the shape is what matters, and the shape is what surprises people. You would assume most of it is the coffee. It is not. The espresso beans in your cup cost the company about 25 cents. The milk, another 21 cents. The flavored syrup, 23 cents. The cup, the lid, and that little cardboard sleeve, about 20 cents together. Add it up, and the real materials in your $6 drink come to roughly 89 cents. That is less than 15% of what you paid. So where does the other $5.11 go? Follow it. About $1.70 goes to labor, the barista and the team around them. Around $1.20 goes to rent, because that store sits on an expensive corner thousands of people walk past every day. Another 36 cents covers utilities, the power and water it takes to run the machines. And about 24 cents covers the slow wearing down of the equipment itself. Now add those 4 together. Labor, rent, utilities, and equipment come to about $3.50. Stack that on top of the 89 cents of materials, and you have spent roughly $4.40 of your 6. That leaves a little over $1.50. And that leftover is not clean profit. It still has to cover everything you cannot see from the register, the corporate overhead, the marketing, the taxes, the head office back in Seattle. Whatever survives all of that is the actual profit on your cup, and it is far thinner than anyone in that line would ever guess. Look at what just happened. The coffee is the cheapest part of the coffee. You are not really paying for beans and milk. You are paying for a decision you no longer have to make. You are paying for the guarantee that a latte in Seattle tastes exactly like a latte in Tokyo, that the seat will be there, that the app will work, that the whole thing will be boringly, reliably the same. And they reinforce that with the menu itself. Look at the sizes. A tall runs about $4.45. A grande, about $4.95. A venti, about $5.45. Notice the trick. Jumping from tall to grande costs you 50 cents for a lot more coffee. And going all the way up to venti is another 50 cents on top of that. Suddenly, the biggest cup feels like the only smart choice, and the small one exists mainly to make the big one look like a bargain. That middle size is bait. You were nudged upward, and you never once felt it. But there is one part of that cost stack that refuses to sit still, and it is the human one. Over the past few years, thousands of Starbucks workers have organized under a movement called Starbucks Workers United, the largest union push in the company's history. It has touched hundreds of stores, fighting for higher pay, more predictable schedules, and better conditions on the floor, with wages pushed towards $17 an hour and beyond. Remember that $1.70 of labor baked into your latte? That number is not fixed. It is a negotiation. And it is the single variable inside the store that can quietly squeeze the entire model, because every extra dollar the barista earns comes straight out of the margin. The people making the coffee are also the biggest cost in the coffee. Okay, if you are still with me, you have now seen where every cent of that $6 goes. But here is the twist. We still have not touched the thing that actually makes this company rich. And it has almost nothing to do with coffee. Remember what I said at the start. This was never really a coffee company. It is a balance sheet with a logo on top. And the most brilliant thing they ever built is still coming. Here it is, the part almost nobody sees. Think about how you actually pay now. You do not hand over cash at the counter. You load money into the app first, $25 here, $50 there, and then you spend it down over days or weeks. Multiply that by tens of millions of customers, all doing it at the same time, and something extraordinary appears on the balance sheet. At the end of its 2024 fiscal year, Starbucks was holding roughly $1.8 billion of customer money that had been loaded but not yet spent. In the financial statements, it has a cold, technical name, stored value card liability. But let's call it what it really is. This is a loan. A $1.8 billion loan handed to Starbucks by millions of ordinary people, one reload at a time. And the interest rate on that loan is 0%. The customers are not charging Starbucks a single cent to borrow their money. They are, in fact, paying for the privilege of lending it. Sit with how strange that is. A bank pays you interest to hold your deposits. A bondholder demands interest to lend a company money. Starbucks skipped all of it. It convinced its own customers to become its cheapest lenders and then to thank the company for the chance. And it gets better because of something called breakage. Not everyone spends every cent they load. People forget. They lose the card. They leave $3.40 on an app they simply stop opening. Across millions of accounts, a slice of that money is never redeemed at all, usually around 10% of everything that comes in. And under the accounting rules, once it is clear that money will never be spent, Starbucks gets to book it as pure profit. How much? In its 2024 fiscal year, Starbucks recognized more than $200 million in breakage. More than $200 million flowing straight to the bottom line without brewing a single cup of coffee to earn it. It is about as close to free money as a business ever gets, and it arrives every single year. So step back and look at what this company actually is. It borrows billions from its customers at 0%. It keeps a chunk of that money forever. And it pays back what it does owe, not in cash, but in frappuccinos. That is not a coffee shop. That is a massive, unregulated financial institution that happens to serve drinks at the teller window. Now, to be fair, this machine is not invincible. There are real cracks, and a serious investor has to look at every one of them. The first is the coffee itself. Starbucks buys enormous quantities of Arabica beans, and the global price of that commodity swings hard with weather, disease, and politics. When bean prices spike, that 89 cents of materials climbs, and the margin narrows from the bottom up. The second is China. For years, China was supposed to be the great growth engine, the market that would carry the company for the next decade. Then a local rival called Luckin Coffee exploded onto the scene, selling coffee at rock-bottom prices and burning cash to grab market share as fast as it could. That price war has squeezed Starbucks in exactly the market it was counting on most, and forced the company to rethink how it operates there, even weighing whether to sell down or license out that part of the business. The third is the economy itself. A $6 latte lives in a very specific place in your brain. In good times, it is a harmless daily habit. But when inflation bites and budgets tighten, that same latte quietly gets reclassified as a luxury, one of the first little things people cut. And when enough people make that small decision at the same moment, foot traffic falls, and foot traffic is the oxygen this entire model breathes. So let's put it all together. Let's build the full picture for a single company-operated store over 1 year. A strong store pulls in around $1,780,000 in revenue. Materials and packaging eat about 30%, roughly $534,000. Labor and benefits take about 28%, close to $498,000. Rent and utilities take about 10%, near $178,000. And everything else, the operations, the depreciation, and the odds and ends, takes about 12%, around $213,000. When the dust settles, that store earns an operating profit of roughly $355,000, a margin of about 20%. A genuinely good business. But now anchor it against the other number. That $1.8 billion of customer money sitting in the app is larger than the total assets held at thousands of small community banks across America. One coffee company holding more prepaid cash than a huge share of the banking system and paying nothing for it. Now, let's run 2 futures for that single store. In the optimistic one, the store sits on a golden corner, the traffic is steady, the app keeps pulling in fresh deposits, and the margin holds above 20%. It hums along like a small money printing machine, and the balance sheet quietly compounds in the background. In the realistic one, the union negotiates wages up by 15%, the price of Arabica jumps, and a local competitor peels away 10% of the morning traffic. Suddenly, that $355,000 of profit can lose more than half its value in a single quarter. And here is the uncomfortable truth hiding in that gap. The difference between a great year and a terrible year is decided almost entirely by forces the store manager cannot touch. Commodity prices, labor movements, interest rates, the wider economy. The person running the store is playing a game whose rules are written somewhere far above their head. Which brings us all the way back to where we started. Starbucks is not in the coffee business. It never really was. It is a bank that happens to sell coffee. So how do you actually get a piece of this if you cannot buy a store? There are 3 real doors. The first, and the simplest, is to buy the stock. It trades under the ticker SBOOKS. Owning shares is the only way an ordinary person captures a sliver of that $1.8 billion 0% loan without ever having to stand behind the counter and steam milk. The second door is real estate. Starbucks does not want to own most of its buildings. It wants to rent them. So if you have serious capital, the move is to buy or build the right lot, ideally a corner with a drive-through lane at a busy intersection, and then lease it back to Starbucks on a long contract, often 10 to 20 years. You are not selling coffee. You are collecting rent from the company that does. And the third door is licensing, but only if you already control the kind of property they need: a hotel chain, a hospital system, an airport terminal. That is the club, and the price of admission is owning the ground first. So the next time you stand in that line and hand over $6, remember what you are really looking at. Not a coffee shop, a financial institution wearing a green apron. If you want the real numbers behind the brands you use every day, subscribe. And next time, we are going to look at why McDonald's is not actually a burger company at all. It is one of the largest real estate empires on Earth.